Welcome to the debate. The financial markets are, they're absolutely fixated on one thing right now: the massive, almost unprecedented rise of the artificial intelligence sector. I mean, we just saw chipmaker Nvidia hit a $5 trillion market cap. The speed, the scale, it demands some serious structured scrutiny.
It really does. And, the sheer size of the capital involved, the velocity of this climb, it naturally draws these almost reflexive comparisons to, the most defining speculative event of the modern financial era, the Dotcom crash, starting back in '99, running through 2000.
And that's exactly our central question today. Does the current AI boom show the same fundamental weaknesses, the same structural fragility that eventually took down the dot-com market? Or does it represent something more durable, a foundational technology shift with fundamentally different, and I'd argue more sustainable market dynamics? I'll be making the case that this is a genuine revolution, and it's grounded in, frankly, immensely strong fundamentals and real profitability.
And I'll be presenting the necessary counterpoint. While the core AI technology itself is transformative, absolutely real, the market dynamics swirling around it, the capital flows, the euphoria, the profound structural risks, these are signaling, I believe, extreme speculative excess and a dangerous concentration that really echoes the most problematic aspects of that dot-com era.
Okay, well, let me start then by establishing why I think this period is fundamentally different. The foundation of today's boom, it's anchored not just by, promise, but by immense, demonstrable profitability and surprisingly mature, widespread adoption. That's a level of stability the nascent internet market just never came close to achieving. Just look at the sector's financial bellwether, Nvidia. It maintains a net profit margin above 50%. I think the latest figure is 53.4%. And its gross margins, they clock in at an extraordinary 76%. This isn't some speculative venture. This is a financial powerhouse creating immense immediate value.
That's certainly a powerful data point for Nvidia itself, though I think I'd frame the context a bit differently. You are focusing really on the very, very top of the pyramid there.
But the top often dictates the structural integrity, wouldn't you agree? Contrast that profit profile to the late 90s. Back then, estimates suggest 80 to 90% of tech IPOs were for companies that were fundamentally unprofitable, burning cash. And furthermore, while valuations are elevated today, sure, key valuation multiples are dramatically less stretched. Take the NASDAQ 100's forward PE ratio. Right now, it's sitting around 26.4x. That figure is, it's profoundly more grounded, more anchored to real earnings than the roughly 60.1x multiple we saw at the absolute peak of the dot-com frenzy. And maybe most importantly, AI isn't some future dream. It's a present economic reality. We have solid data here. An estimated 78% of organizations globally report using some form of AI already, and it's delivering measurable productivity gains. We're seeing reports of up to a 50% boost in efficiency within major banks, for instance. This provides a stable, revenue-enhancing economic foundation that frankly just didn't exist back in 2000.
I see why you emphasize the profitability of, the big infrastructure players, Nvidia, the cloud providers. But I think we have to look beyond those few giants to really grasp the true speculative fervor that's driving this market. While the technology is real, yes, the capital flows into the wider ecosystem, they mirror the most dangerous aspects of past manias.
Okay, so what specific data points in that broader ecosystem, outside of the top 3 or 4 firms, lead you to that conclusion?
Well, my first piece of evidence points directly to the sheer froth in the startup space, because that's where speculative capital truly pools, right? A huge percentage of new AI ventures are completely, utterly untethered from traditional financial metrics. We're seeing estimates that around 70% of certain AI unicorn cohorts. These are companies valued at over $1 billion, mind you. They have no measurable revenue. Zero. Yet they command these billion-dollar valuations purely on, future potential. That level of profitless growth in the majority of new entrants, it feels eerily similar to the metrics that ultimately doomed so many companies back in the late 90s. And second, the capital just pouring into this sector. It's showing alarming concentration and, frankly, a kind of desperation. We've seen figures suggesting 53 to 58% of all global venture capital funding flowed into AI startups in just the first half of 2025 alone. That's intense. And this desperation has led to some, frankly, irrational, unprecedented metrics. We've documented instances where the valuation per employee in some of these newer AI companies is reaching up to $1.2 billion. That figure, $1.2 billion valuation per employee, it frankly borders on the absurd. We are valuing future hopes at absolutely historic highs.
Okay, I hear you on the unicorn figures, and they do sound, well, terrifying on the surface. But aren't they still relatively capital constrained? They represent a tiny fraction of the total market capitalization, which is overwhelmingly controlled by the profitable giants we talked about. Isn't it more like localized froth? Froth that will likely burn itself out, sure, but not necessarily a systemic collapse risk like the Dotcom bust represented.
I have to disagree that it's localized, because the final, and I think most critical risk factor, is systemic concentration. The fact that just 10 stocks now represent roughly 36% of the S&P 500's total weight. That profound lack of diversification doesn't just skew risk, it practically guarantees structural weakness exists right at the very core of the market, regardless of how well Nvidia does in any single quarter.
All right, let's dive deeper into those valuation metrics then, because I really believe this is where the difference between 2000 and today is most stark and ultimately most reassuring. You highlighted the froth in the startup space, which, okay, I grant you is concerning. But the structural integrity of the public market, that's best measured by the major indices, right? The stark difference between the NASDAQ 100's peak PE of, 60.1x in 2000 and today's 26.4x, that suggests a fundamentally more rational, earnings-focused market. We aren't paying 60 times current earnings based purely on speculation about eyeballs or, future user growth. We're paying less than half that multiple, and it's anchored by real massive revenue generation today.
I have to reject the premise that the Nasdaq's PE of 26.4x is inherently rational or, indicative of broad market health. Yes, the Nasdaq 100 multiple is significantly lower than the 2000 peak, but that single metric, I think, hides serious underlying issues. Look at the broader S&P 500 PE ratio. It stands at 22x today. That is rapidly approaching historical Dotcom era peaks.
But isn't it still driven by actual earnings growth in the majority of those S&P 500 component companies?
The problem isn't necessarily a total lack of earnings across the board. The valuation dislocation today is simply concentrated. It's focused almost entirely on those mega-cap AI leaders, Nvidia, maybe a handful of others, rather than being spread thinly across hundreds of unprofitable companies like it was back in 2000. This concentration, it doesn't magically reduce the total market risk, it just makes the risk profile less diffuse, more pointed, and arguably far more severe. If those top 10 stocks, the ones making up that enormous 36% chunk of the S&P 500, if they hiccup simultaneously, well, the systemic shock could be devastating, even if the underlying AI technology itself continues to advance unimpeded.
I might frame that concentration differently. Perhaps as efficiency. Capital is flowing aggressively toward what the market perceives as the highest quality assets with the strongest moats. Isn't this just the market maturing, recognizing where the immediate massive profit actually accrues? It might create volatility, sure, but it doesn't automatically guarantee a systemic crash rooted in a universal lack of underlying value, which was the 2000 story.
I take your point on profitability, but maybe we're looking at the wrong part of the value chain. That very concentration of profit you describe, it might actually be masking a fundamental flaw in the wider AI economy. And that brings me to the sustainability of this profitability versus cash burn dynamic.
Yes, I agree. We absolutely have to address the cash burn issue.
Precisely. What we're seeing is a classic shovel seller's dynamic, right? But it's amplified to an extreme degree this time. While the AI model developers like OpenAI, Anthropic, they're the innovators, yes, but they're also the prospectors. And they are burning massive amounts of cash just to stay in the game, just to compete. Take OpenAI. Their estimated annual computing costs are around $5 billion. That figure actually eclipses their projected 2025 revenue of $4 billion. This massive deficit, it isn't just an operating loss on the books. It's a direct recurring transfer of capital straight to the shovel sellers, the infrastructure providers, the hardware manufacturers like Nvidia. So this concentrated profit accrual, benefiting the few, is effectively masking systemic structural cash burn across the majority of the AI ecosystem. It feels highly reminiscent of that financially unsustainable, profitless growth narrative of the past. It creates a kind of choke point.
Okay, I see the shovel seller point, but I'd argue that that dynamic demonstrates the strength of the foundation, not its weakness. The sheer immense profitability and market dominance of those infrastructure providers. That's exactly what differentiates this period. You call it concentration? I might call it a stable foundation of value extraction. This isn't profitless growth overall. It's extremely concentrated profit. Nvidia's 80% plus GPU market share, that 76% gross margin, it proves that capital is being deployed effectively to create tangible, revenue-enhancing assets.
But isn't the money flowing out of the core ecosystem of innovation rather than compounding within it? The sheer cost of running these sophisticated models is becoming so high that it creates, arguably, an insurmountable barrier for new entrants. And doesn't that just cement the monopoly power of Nvidia and the big hyperscalers? That seems like a structural problem that could limit future competition and innovation downstream.
Billions represented by these huge infrastructure deals, like the massive agreements between model developers and cloud providers. That capital is funding tangible infrastructure which eventually, I believe, enable competition. The history of tech kind of suggests that monopolies like this tend to invite an extraordinary flood of competing capital, doesn't it? We're already seeing customized silicon efforts, the rise of competitors like AMD and Cerebras. Even the hyperscalers themselves are building their own internal chips. That 76% gross margin for Nvidia, it feels like a temporary snapshot, albeit an immense one, right now. The capital today is creating a tangible, revenue-enhancing asset base that enables that 78% adoption rate we talked about.
That seems fundamentally different from funding, speculative consumer portals that lacked any viable business model back in 2000.
That's a compelling argument regarding the underlying technology's real-world impact, and certainly the hope for future competition chipping away at those margins. But let's pivot then, maybe to our final core point. The tension between technology maturity versus the inherent structural risk of this market concentration.
Okay. And I'd reaffirm here that AI's existing maturity, its deep integration already, provides a fundamental stability that the nascent internet just lacked back then, when, as we said, 78% of organizations globally report using AI, and we're seeing measurable, significant productivity gains across industries. That's not a speculative fad. That is foundational economic stability. AI is already delivering tangible value. That dramatically reduces the likelihood, in my view, of a total systemic collapse like the Dotcom burst, where entire business models just failed completely because the consumer base, the underlying infrastructure, it just wasn't ready.
The technological maturity is, I agree, undeniable, but that maturity doesn't necessarily inoculate the public market against a structural collapse driven by, speculative capital flows and, most critically, that concentration risk. I really want to return to that systemic fragility. The simple fact that 10 stocks now represent 36% of the S&P 500's total weight. That represents a unique and, I think, dangerous structural setup.
But again, those companies are profitable, unlike so many of the dot-com leaders whose failure was ultimately due to having zero revenue or worse.
Their profitability simply centralizes the risk profile. Look at a metric like the S&P 500's effective contributor count. It's a sophisticated measure of market diversification, essentially calculating how many different stocks are genuinely influencing the movement of the overall index on any given day. That count, it's currently sitting at a 15-year low.
Right. And what does that mathematically signify for, say, the average investor?
It signifies that the market's fate, its overall direction, is tied to fewer input vectors than at any point since the global financial crisis. When that effective contributor count is low, it means idiosyncratic risks, a sudden regulatory shock hitting one sector, a major earnings miss, even key personnel turnover within just those top 10 companies has an outsized, potentially massive impact on the stability of the entire index. We're depending, to an unhealthy degree, on those few top companies whose market caps already dwarf historical benchmarks to maintain essentially flawless performance indefinitely. That structural risk, layered on top of the speculative euphoria we both acknowledge exists in those 70% revenue-less unicorns, that is the true bubble signal here in my view.
So just to clarify, you're identifying a systemic fragility created by the market structure itself, even while acknowledging that genuine generational technological progress is driving the core investment thesis.
Precisely. That structural risk, the one created by this extreme concentration, is really the central thesis of the bubble argument today. We have this foundational, world-changing technology, absolutely, but it's currently trapped within a market structure that almost guarantees painful volatility, perhaps even a severe correction when these highly valued winners eventually, inevitably, hit turbulence.
Well, this has certainly been a rigorous and, I think, necessary comparison. To summarize my position then, the core financial fundamentals, the profitability, and the widespread tangible adoption of AI technology fundamentally distinguish this era from the dot-com bubble. The lower, albeit still elevated, PE multiples on major indices are anchored in real earnings, and the immense profitability of leaders like Nvidia indicate a much more resilient core this time around. The challenge for investors, as I see it, is to meticulously separate the fundamental revolution, which is real and ongoing, from that localized speculative froth, which, yes, we both agree exists, particularly in the startup ecosystem.
And from my side, while I absolutely acknowledge and respect the strong profitability and dominance of the leading infrastructure firms, these pockets of extreme speculation, namely that high percentage of revenue-less AI unicorns, the frankly absurd valuation per employee metrics popping up, and most critically, the severe market concentration risk where just a handful of stocks hold 36% of the S&P 500, they demand that investors remain deeply skeptical of the overall market valuation. To simply dismiss this as localized froth is, I fear, to willfully ignore severe structural risk factors that have historically preceded sharp market corrections. The froth is real, and its potential influence is significant.
I think our discussion really confirms that the AI boom is a complex, kind of dual phenomenon, isn't it? It's a profound mix of speculative excess layered right on top of a genuine generational technological shift.
Absolutely. And navigating this moment clearly requires disciplined, strategic approaches, ones grounded in understanding both those unique structural risks presented by concentration and cash burn dynamics, and the profound long-term opportunities that technology itself presents. There is certainly much more to explore in how these dual, almost contradictory realities will ultimately play out in the market in the coming years.